You're watching The Money Show, and I'm Kavita Thapliyal, and this show is your daily dose of money insights. Today, we decode the November AMFI data with equity inflows surging and SIPs holding strong despite all the market noise. That's right. If there's one message coming through loud and clear, it's the Indian investors are staying firmly in the equity camp. Despite market volatility, geopolitical worries, and shifting global liquidity, domestic flows continue to signal unwavering confidence. November saw India's mutual fund industry scale a fresh peak, AUM rising to 80.80 lakh crores, up from 79.87 lakh crores in October. But the real story is in equities. A strong 21% month-on-month jump in equity mutual fund inflows to almost 29,911 crores, powered by rock-solid SIP inflows and held steady at 29,445 crores. Now, even as debt funds witnessed sizable outflows after October's surge, investors clearly preferred staying invested in growth assets, with mid-cap, small-cap thematic funds attracting strong interest. Now, let's take an industry view where definitely the AUM has reached to 80.80 lakh crores. Month-on-month net flows for the industry came in at 32,755 crores compared to 21,565 crores in October. Equity funds, if we talk about, they saw strong, steady and surging numbers. Net equity inflows jumped to 29,911 crores, sharply higher than 24,690 crores last month. SIP inflows also remain steady at 29,445 crores, underscoring the resilient retail participation clearly over here. And category-wise, if we look at the flows, continued. The equity domination is clear in the numbers. Large caps are at 1639 crores versus 971 crores month on month. Mid caps, as compared to 3807, the number of 4489 crores month on month again. Small caps, again, a reviewing interest coming in. Month on month, we saw the numbers coming in at 4406 crores as compared to 3476 crores. And sectoral thematic funds have made a comeback. We can also look at this as per NFO's launches, etc. But the number is really alarming. Is 1864 crores month on month. Now, despite continued valuation concerns in pockets, investors clearly showed faith in long-term compounding. The debt fund outflows have also dominated this time in the numbers. Debt category saw meaningful withdrawals in October's unusually high inflows. Total debt outflow we can look at is 25,692 crores, where liquid funds alone reported almost 14,050 crores in a outflow versus a massive 89,375 crores outflow last month. Corporate bond funds slowed with inflows of almost 1,525 crores, down from 5,121 crores. Credit risk funds continue to see pressure with 117 crores in outflows. Hybrid ETF and alternatives, strong inflows in ETF. The numbers coming up at 9,720 crores, higher than 6,181 crores in October. Gold ETFs inflows moderated sharply to 3,741 crores versus 7,743 crore last month, a sign of investors shifting back from defensive assets towards equities and a mild risk-taking as well. ALSS funds continue to see net outflows at 570 crores, though slightly improved versus 665 crores earlier. What's the broader takeaway when we look at the numbers? Despite volatility, November marks a month of resilient equity participation, stable SIP culture, tactical rotation away from debt. Investors appear to be positioning for long-term growth, trend that may continue into early 2026 if markets remain steady. But then let's deep dive and understand these numbers. We have our expert Sujit Subramaniam on the show today, who will help us decode this trend and also what are the investors hinting towards. Hi, good evening and welcome to the show. And sir, what an interesting set of numbers, last month where we saw investors, shying away from mid-cap and small cap. We see a strong comeback over here, including large caps. And yet again, we can see a lot of thematic and sectoral funds also gaining investors' interest. So what's your broad takeaway? Let's begin with that.
I think broad takeaway is the continued confidence of the Indian investor in the Indian economy and in the Indian growth story and of the stock markets. I think that comes through very, very clearly. Because you did mention the number of 29,000 crores, which is a 20% increase month on month. But let me tell you, that's only part of the story. That's the active equity funds like large cap, mid cap, large and mid cap. But there is another category called the passives, which are non-active, like ETFs and index funds. There again, we saw a sharp increase month on month. And the third category where fund managers get to deploy in equities are this category called hybrid funds. You have conservative hybrids, aggressive hybrids, multi-asset allocation, and dynamic asset allocation. All those categories also saw strong inflows this month. So when I put together the total equity pack, right, the active equity plus the passives plus the hybrids, then you're seeing that there's a 26% month-on-month increase in the flows and touching 50,000 crores, which means, let me summarize, fund managers have got 50,000 crores additional money to buy equities, almost 50,000 crores of equities in this month. So I think that indicates that it's a virtuous cycle, that customers are reposing faith in the fund managers. The fund managers invest, in turn can go and buy what the FIS have been continuously selling. So I think that it's a self-fulfilling prophecy. This confidence by the retail investors will help the markets to be less volatile and keep their confidence going. So I think it's a very, very important figure that a 50,000 crore number has been given to the mutual fund managers. One another thing which I want to point out is that these numbers of 50,000 crores that I pointed out are the net flows. Now, as you know, there's a gross inflow and there are redemptions. A fund houses, A fund may get money, but a B fund may have redemptions, or another fund house may lose. So this net figure is what is shown as the number that we just spoke about, which is 50,000 crores. But if you now look at the number and see, were there increase because the gross flows increased, or was because redemptions came down? The redemptions came down 20% month on month. This is the second thing that points to the investor that in a time of volatility, as Kavita mentioned, there's been a huge amount of international noise around Fed rate cuts and tariff wars and all of that. Despite that, redemptions have come down month on month. And this is what has helped the net flows to grow strongly. So I think here again, the faith of the investor to stay invested and the SIP book being flat also indicates that despite all the volatility, they are staying flat. Now, if you do another deep dive into it, into the categories, I think Kavita mentioned this, that gold ETFs, for example, though they are still positive 3,700 crores, were 4,000 crores less than last month. Now, the strong 50% rise in gold prices means that they probably felt, oh, the rally is done. Maybe that's part of the money shifting into equities. So that's again a very healthy sign because gold is a passive defensive asset class, as we know. And if people are switching from passives to actives, that indicates they're increasing confidence. Then also, if you see the other factor here behind this 50,000 crore net inflow is that almost all the categories, barring a few like dividend yield funds or ELSS, which due to the tax law changes have lost their charm, have given positive net inflows this month. So broad-based confidence of the customers in the entire mutual fund category of equity related assets. And which were the toppers there? Of course, passives, which are ETFs, had a huge increase this month of 3,300 crores. But close behind them were this pack of large and mid cap, and small cap. So clearly, we know that the mid caps are broadly linked to the domestic growth story, right? And so the confidence in the mid and small cap, despite the fact that the small cap has been the most underperforming in the last 1 year in the stock market, the Nifty small cap index 100, small cap 100 and 250 have been the worst performers, but customer confidence is showing through. The other category is not everybody is very risk taking. Yeah. So there's this debt shift which Kavita has talked about. Where has that money gone? That has gone into the hybrids category. So if you look at dynamic asset allocation and equity savings, you've seen a month on month, they are among the winners. So I would say that clearly all kinds of investors, moderate risk as well as aggressive, have reposed their faith in the market this month.
Right, right. One thing I want to talk about, since we spoke about redemptions reducing, the SIP cancellation numbers have also gone up month on month. In fact, it's at record high also. How do we understand this with this kind of a data that's coming up for November now?
The reason for that's happening is that, the direct investors, there are guided investors through mutual fund distributors and registered advisors, and there are people who directly go and put money into SIPs. The ones who put directly, when they hear this news, they tend to cancel their SIPs. But those who are guided by mutual fund distributors, they tend to stay the course because the whole rupee cost averaging comes to its best advantage only when there is corrections. So I think the long-term SIP intention was. Second is if somebody puts a 3-year SIP and he says in 1.5 years he's facing tension, he says, why not I take the out? But a person who's investing for 10 years and 15 years, he retains his faith. So I would attribute the cancellation to do-it-yourself SIPs, which people tend to do on their own by looking at the past performance of schemes and just clicking a button. See, the ease of doing business which has come to the industry in terms of very quick transaction processing also helps redemptions be done very quickly. These are, I think, more trigger-happy kind of investors. Those who are advised by distributors, I would say that they generally don't tend to redeem prematurely their SIPs.
Absolutely. So one clarity, which I really want to understand also, the SIP numbers. So redemptions have reduced, but at the same time, there are no new SIPs. There is no new money in SIP coming. Should we understand it that way?
No, no, no. There is more new money coming in. Despite the redemptions, the number is stable.
Right.
So
Okay.
fresh investors are increasing by the day, but existing ones are canceling. That's why the net book remains flat. So the very fact that despite cancellations going up, your net book is means that the gross people who have come in and opened fresh SIPs have exceeded the number of people who have cancelled their SIPs.
Right. Let's also touch upon the kind of category experiment that we are seeing investors doing. In October, we saw a lot of money going in flexi cap, some amount going in hybrid also. But this time, we are looking at large cap and mid cap, small cap again coming back in the flavor. Even thematic and sectoral inflows we can see going up. ETFs are doing brilliant. So, what exactly is the investor experimenting with? Are they really now have understood that stability and consistency is the way to win good returns in the market?
That's partly the answer. It's partly also the answer that it's not the same investor putting some money in large cap, some mid cap, some in hybrids. It's the risk appetite of the investor. So I think the aggressive investors who have come in earlier into hybrids have now understood the markets, are comfortable, are now going into the mid cap and small cap. Whereas those who are new entrants are probably entering through the hybrids. So I think it's the investor mentality in terms of risk aversion or risk comfort, right? Which decides whether they choose mid cap or small cap or hybrids. So I wouldn't say that one investor puts in all the asset class categories, right? That's very rare to see. So if I'm a risk taker, then I would avoid hybrids. So if I'm a conservative person, I would then allocate 40-50% to the hybrid category and maybe the ballast in large caps. So it all depends on the risk profiling of the investor, that this different categories. So because it's been across the board this time, it means that all types of investors have reposed faith in the market this time.
Any alarming figure in the numbers, which also maybe decode some kind of a trend that we might see in early 2026?
So I think that it's basically the resilience of small cap.
Right.
You see,
Okay.
small cap had their worst year.
Yeah, totally.
Right? They've underperformed the Nifty and the mid cap index hugely. So in 1 year returns. Despite that, small cap inflows have gone. So if that's the case, then if the new year comes in with the festive season numbers reflecting in the EPS growth, then the confidence will grow up and then small cap flows can actually gather pace even more. So I would say that small and mid caps are the story for the 2026 that we need to watch out for, both in terms of flows and probably in terms of earnings growth and stock market performance.
Absolutely. And I'm sure you'll be there with us to handhold our viewers and investors on this in coming months also. But then with that, it's time up on the show. Thank you so much for joining us and helping our viewers understand the right approach and the right way to understand these AMFI numbers, everyone. Thank you so much. And it's time for a short break, but then post that, let's get you our very special segment, SBI Bharat Nivesh, where today we'll be focusing on the importance of bucketing and aligning a specific fund to a specific goal.